So we're going to talk about state taxes, and state taxes are really a fascinating area because aside from things that you're familiar with, and we're going to talk about, we'll talk about sales taxes and income taxes and what's something called the gross receipts tax, and when you're subject to it, something called nexus. There's a whole range of weird taxes for states. For example, even before the legalization of marijuana, there were marijuana taxes, which is odd because it wasn't legal at the time. Secondly, why does Arkansas, or what do states around Arkansas have a chain store tax? Well, that's because they were trying to stop Walmart. Why does South Dakota have a large vessel tax? We'll also talk about the range of tax rates that go from 0 to 13%, the application of minimum taxes in certain states, and the fact that some state taxes are not creditable against your Canadian tax liability. Some states even have taxes where you can lose money and still be subject to tax. In determining whether or not you're subject to state taxation, the very first question you have to answer is, does the corporation have nexus in that state? Now, nexus is the minimum level of contact needed for that state to tax a business from outside the state. The threshold for taxation under nexus is physical presence. And that includes physical presence of your employees, of your property, and even your sales representatives. These are individuals who oftentimes are not employees, they're independent contractors. When they go into a state to conduct business on behalf, they create nexus for you in that state and allow the state to tax the Canadian business. Nexus is even broader than just physical presence. There's a recent Supreme Court case called Wayfair. That's the online furniture sales company who is delivering products across the US but didn't pay sales tax or income tax in many states. They said they didn't have to have a physical presence in a state to be subject to state taxes. The expansion of nexus to include situations where it's not just physical presence is a huge issue for online sellers. And those include companies like Amazon and Fulfillment by Amazon, eBay, others that sell online in terms of what their tax obligations are in states they sell to, where previously they didn't have a tax obligation. The expansion of the nexus rules to include activities other than strictly physical presence has a significant impact on Canadian businesses that sell through online sellers like FBA or Fulfillment by Amazon. These have state tax implications that need to be evaluated for their impact on their business. So once you've determined you have nexus in a state, now you've got to look at the implications of that. And one of the first ones we talk about is sales taxes. Sales taxes only apply to sales of tangible personal property. You say, what's tangible personal property? Well, tangible personal property are things you can touch and feel that aren't real estate. And so that includes chairs, tables, desks, computers, all that sort of thing is tangible personal property. And it's subject to sales tax when it's sold in a state that you have nexus in and it's sold to the end user. It's not subject to sales tax if you sell to a reseller. So if someone's going to resell that good, you don't have to collect sales tax. But, and this is an important but, if you don't receive a resale certificate from the reseller, and if they don't collect and remit the tax when they resell it, your business is still on the line for that. So it's critical that your business obtain resale certificates from it. And most states will issue their own resale certificate. There's something called a multi-state resale certificate you can also get. So sales taxes are a lot of dollars because it's based on the gross amount. If you said you did $100,000 of sales and it's a 7% sales tax, you're talking about $7,000. That's a lot of money. Now, interesting enough, you know the US has 50 states and one, the District of Columbia, but there's something like 10,000 or more taxing jurisdictions in the US. So what you find is if you go to most states, is that not only is there a state sales tax, but there's also sub-jurisdictions within that state, counties and cities and districts that also have their own state taxes and sales taxes. So if you sell something in King County, where Seattle is, it's a different rate than if you sell something in Everett, which is just north of Seattle. So you got all these little jurisdictions that each have their own sales tax rate. So this is a significant undertaking to understand what your obligations are and your reporting obligations with respect to sales taxes. What state sales tax you pay? Well, it's based on where the product is delivered, not where you received a check from, not from the location where the person who ordered the product is where did you deliver that product to. If you deliver it to Nebraska and you have nexus in Nebraska, you have Nebraska sales tax. And remember, it's your customer that's going to pay the sales tax, not you. You just have an obligation to collect and remit the tax. So what happens when you don't do that? Well, you'd be surprised to find out that states are actually pretty active in the collection of their taxes in Canada. In fact, in my career, I've seen more activity in Canada by California than I have from the US federal government. What you'll find typically is sometimes they won't identify you directly. They will audit one of your customers in a state, and they'll see your name on a list of suppliers and they'll say, who is ABC company? And the guy that's being examined will say, well, they're up in Canada. And the state will send you out a nice little letter that is called a nexus questionnaire. And on that questionnaire, they'll ask a bunch of questions. And if you don't respond to them, they'll actually follow up with you. If you do respond to them, it'll be signed under penalties of perjury. So I can't recommend that you don't do that truthfully. Oftentimes, that nexus questionnaire is incriminating. By the time you get it, it's too late to take anything but defensive action. What you really want to do is examine what your exposure is before you get to that point, because there are alternatives available to you to fall under something called voluntary disclosure agreements, which allow you to get a less painful resolution of the sales tax obligations. We're going to talk about state income tax. Nexus applies to it as well, but it's slightly different for income taxes. If you have business activity in a state where you're selling tangible personal property and your only activity is soliciting sales of it, then you're not subject to state income tax. But solicitation is very, very narrowly defined. Solicitation does not include training your customers how to use a product, training your salespeople how to sell a product, collecting bad debts, doing warranty repairs in a state. None of those things are solicitation only. So it's very narrowly defined what is pure solicitation. It also doesn't apply at all to service activities. Where your company provides services in a state, it's subject to state income tax. So if you're an architect in Vancouver and you fly to a meeting to meet with your customer in Los Angeles and have a meeting there and then go back and do your architectural drawings in Canada, some of the activity was in the US and it's subject to California income tax because you had meetings in that state and are subject to tax there. State income taxes have an interesting component to them in terms of how they're determined. They're determined by something called formulary apportionment, not by separate accounting. So if you said, well, I did a bunch of business in Oregon, but I lost money there, the state really doesn't care. They don't want 100% of nothing. They want their share of your business's income. For some states, it's your total profits in the US, and for other states, it's your total profits worldwide. So you could say, I lost my shirt in Oregon, but I made $1 billion worldwide. They just want their 0.0001% of your worldwide profits, not 100% of nothing. The good news with state income taxes is, for one thing, they're relatively small compared to federal income taxes. Secondly, they're fully creditable against Canadian income taxes. So if you're a Canadian business doing business in the US and you pay state income taxes, that tax really doesn't cost you any money, it costs the Canadian government money. State income tax rates range quite widely. You have several states that do not have a state income tax. Notably, Washington, Texas, Nevada, and several other states do not have any state income taxes. Other states like New York and Florida are quite high. They go up to almost 13%. That's a significant amount, much higher than the average rate, which is probably closer to 5 or 6% in terms of state income tax rates. You're going to go where your profits potential is highest. Some of those states like New York and California have higher tax rates, but they also have a lot more of your customers than maybe other states do. Some states with higher tax rates like California, it's kind of like the price of admission to be in that state. They have a lot of potential customers for your business. So I wouldn't encourage you to avoid taxes. You have to be careful when you let tax advisors tell you how to do your business, because we can help you avoid taxes entirely, but you won't make any money. One of the interesting things about some states is they have minimum taxes. That means you'll be assessed a tax even if you didn't have any activity in the state, as long as you had nexus there. Notably, California's minimum tax is $800. Whether you make money or not, you could lose money worldwide, you'll still pay the $800 if you have nexus in California. Other states have lesser amounts. Massachusetts is oddly $454 and Arizona is $50. Most states are the lower amounts, not the higher amounts like California. One of the interesting things about state taxes is, I've mentioned, several states do not have income taxes, but they do have other taxes. And the three notable states I want to mention to you are Ohio, Texas, and Washington. All of those states have something often referred to as gross receipts taxes, as opposed to income tax. In other words, these are a tax on your gross sales within the state. And they have a range of implications that are different than income taxes. In some cases, they're very attractive compared to income taxes. Washington State's is about 0.5% to 1.5%. That sounds great, but if you're in a high volume, low margin business like the grocery business, it's the equivalent of a 50% income tax. So these are significant differences that these states have. Some of them, like Washington, don't have any modification associated with them. Others, like Texas, allow you certain deductions. But these dollars can add up really quickly, and even when you're losing money, you can be subject to that state's tax. And sometimes where you have multiple sales within a corporate group, in Washington State, for example, you can pay that tax multiple times. So you need to be careful about that when dealing with states like that. They can be relatively complex systems, even though they're fairly simple-minded. A notable difference between state income taxes and these gross receipts taxes is that, unlike the income tax, the gross receipts tax is not a creditable tax for Canadian income tax purposes. So when you pay gross receipts tax in Texas and Washington, Ohio, you don't get a foreign tax credit in Canada for those taxes paid. So there's some aspect of double taxation there. But with 10,000 taxing jurisdictions, it's difficult to know, what do you do about that? Well, one of the first things that we do with businesses is to evaluate, saying, let's understand where the state taxes are the most significant for us to make sure we put our efforts where they're most significant. Some states, I can't tell you that you don't have a liability there, but you may be willing to say, hey, I can risk losing $15 in one state, but I can't risk losing $15,000 in another state. If you don't deal with these issues, you're going to have fewer opportunities to deal with them effectively and as aggressively as you could where you do deal with them. So we do recommend that you be proactive in your approach to dealing with state taxes rather than dealing with it after the fact. After the state's contacted you, it's probably too late. Before they've contacted you, it gives you a much broader range of alternatives that you can use to manage your tax liabilities.